to see everybody, like I said, and welcome back, guys. Keep in mind, every week, usually on a Tuesday or Thursday, we like to invite one of our special guests to come on to provide a quick webinar of their own. Great to see everybody. Ronald, Doug, Salman, one of our students with us, Lars, David, Justin, the whole crowd. Perfect. Well, like I said, guys, every week we'll bring on a special guest of ours, and nonetheless today, just like any other week, we have a very special guest of ours today from the Mad Hedge Fund trader, John Thomas. Now, of course, John's topic today, as the topic title says, the melt up continues. So as far as what John will be going over today, he'll be discussing the top trades to make with Donald Trump's big tax cuts on the horizon. So he'll give you a little bit of his insight as far as what's to come. He'll be talking about the 20-year boom in this industry and how it could help you retire early, and ultimately hedge fund strategies that returned 58% and above the last 12 months. Guys, if you look at the Dow average, the Dow only returned 17%. So John is well above and beyond a lot of the experts' projections himself. So to give you a little bit of information about our presenter today, John Thomas, well, John is a 50-year veteran of the financial markets. He spent 10 years as a financial journalist, 10 more years trading for a major investment bank, and another decade running the first dedicated international hedge fund. Seeing the incredible inefficiencies and severe mispricing offered by the popping of multiple bubbles during the great crash of 2008, and missing the adrenaline of the marketplace, he returned to active hedge fund management. Now, with the Diary of a Mad Hedge Fund Trader, his book, of course, his goal is to broaden public understanding of the techniques and strategies employed by the most successful hedge funds, so that he or they may have more profitability to manage their own money. So like I just said, John publishes a daily research newsletter and offers one of the most successful trade mentoring services in the entire industry. He currently has followers in 134 different countries. So without further ado, John Thomas, the floor is all yours. How are you today?
Hey, Josh. Thanks for the great introduction. I'm honored to be a guest of Cyber Trading University. Obviously, you've built yourself a very successful business. Otherwise, you wouldn't have so many followers, and you wouldn't have so many people interested in listening to me. Okay, well, why listen to John Thomas? I have 50 years of experience in the global financial markets, 10 years as the economist correspondent in Tokyo, Japan, and later the White House, 10 years running the international equity division at Morgan Stanley, brief vacation as a Marine combat pilot in Desert Storm, 10 more years running the first international dedicated hedge fund, then 5 years fracking for natural gas in West Texas, and now 10 years publishing the Diary of a Mad Hedge Fund Trader. I am one of a handful of founders of the modern hedge fund industry who is still working, and I do it because I love it. This is the other reason to listen to me. A lot of people have all the experience in the world and never make a dime in this business. This is our trailing 1 year return. This is a daily audited performance. It's independently audited, and we're now showing a 55.66% trailing 1 year return. Did I have a lucky year? Am I a one-term wonder? Well, this is the same daily return going back 8 years, and we have an average annualized return of 34.5%, handily beating the market while minimizing drawdowns. That is the goal. Keep the performance chart moving to the upper right-hand corner at all times in all market conditions. I do tend to get around a lot. This is me at a skeet shooting championship in Auckland, New Zealand. I got first prize. I forgot to tell them I went to the sniper training program at Camp Pendleton in California with the U.S. Marine Corps. I did set a course record, but the prize was a bottle of champagne, and I shared it with everyone. If you are not up 55.66% in the past 12 months as I am, you are reading the wrong newsletter or following the wrong trade mentoring service. There is a seller strike right now in the market. If you sell your stocks now, you're going to get hit with a backbreaking 39% tax rate and 55% if you live in California. If you wait only 4 more weeks, that tax rate could drop to 20%, 15%, or maybe to nothing at all. So why sell now? Investors are maxing out 2017 pension fund contributions to minimize this year's taxes, and all the money is pouring into stock index funds, creating the melt-up that we have seen for the past 2 months. So you should be gaming your taxes big time. Take maximum advantage of the coming tax changes. Roll as much income as possible into 2018 to cut your 2017 tax bill. 2018 taxes are not payable until April 15th, 2019. So you have free use of the money till then and do things like trade the market and make the money to pay your tax bill, which is what I do every year. You should be deferring all capital gains until next year, like the rest of the world is, or at least the rest of the United States. Accelerate all deductions into 2017. Max out pension fund contributions this year. Pay local real estate taxes and mortgage interest in advance. And I've already paid my own home taxes for all of 2018, so I can deduct them this year because next year they're not going to be deductible. And if you run a company, pay your employee bonuses this year as opposed to next year. This is my secret weapon in the markets, my Mad Hedge Market Timing Index, showing today a reading of 69, which is showing moderately overbought. We've been living in the 50 to 98 range for the last 2 months as the market goes from being overbought to having flatline corrections, then being overbought again. Why do you need an algorithm to trade a markets? Well, why use a toolbox missing its most important tool? Algorithms have become so dominant in the market, you should never trade without one. It does the work of a seasoned 100-man research department in seconds. It runs real time and optimizes returns with the addition of every new data point far faster than any human can. Imagine a trading strategy that upgrades itself 30 times a day, if not 30 times a second. Don't go to a gunfight with a knife. If you are trading against algos alone, you will lose. Algorithms provide you with a defined systematic trading discipline that will enhance your profits. This is the buy and sell signals generated by our algorithm for the past 3 years. And as you can see, we get several strong buy and sell indicators every year. Gives you a lot to trade around with and definitely can enhance your own trading profits. This is a few of the inputs. A lot of them anybody can guess. 50 and 200-day moving average, the VIX, 52-day highs versus lows, the McClellan index, put call ratio, RSIs, and so on. So a lot goes into this algorithm. Of course, we're always adding new indicators and then back testing them 30 years to see if it can even increase our returns. Let me give an example of how our algorithm works. In the last 3 years, the S&P 500 has been up 38.77%. The Mad Hedge performance has been up 114.13%. That is nearly a triple performance of the S&P 500. Give you a few specific stocks. Got strong buys in Goldman Sachs in the beginning of September, stayed long, and sold out just as the market was topping in the beginning of June, and we jumped back in at the November lows. And this thing has been basically making money for us every single month. We now have a double long position in the financials, which we think will go much higher. And this is the most interesting chart of all. This goes back to the beginning of last year when we had the presidential election. And our algorithm knew 10 days before the election who was going to win. I thought Hillary Clinton was going to win like the rest of the world. Our algorithm knew Donald Trump was going to win by putting out a strong buy recommendation to buy U.S. steel. And then keeping us long all through that giant rally right after the election. So again, algos can see things that we mere humans can't. There is a method to my madness. The global stock market melt-up has taken stocks to record valuation and momentum highs. Great third quarter earnings are adding fuel to the fire. Look for the tax bill to introduce more volatility. We saw three 300 range points last week. That will continue. It's not all going to be a big kumbaya. Sell every bond rally. The Fed put the top in when they announced they were selling $4 trillion worth of their bond hoard. And global QE is grinding down to a close, should start exhibiting a negative flow of funds by next October. Look for the main indexes to grind up for the rest of 2017. Keep buying hedges like gold on dips as a hedge against brief profit taking in stocks. While oil stocks on the dips, sell currencies on any rallies, the top is in. And that is me flying a P-51 Mustang. It's a World War II fighter plane. If you're wondering why I'm in such a good mood, it is a fabulous plane to fly. If you don't know what a P-51 Mustang is, that is a P-51 Mustang. It's almost a cross between a jet fighter and a piston fighter. It has so much power. Trading a new tax bill. This is the passage of the tax bill is triggering a major rearrangement of new cash flows into the stock market. You want to go out of growth into value. You want to go out of large companies into small ones. That's why the Russell 2000 has been outperforming so much over the past 2 weeks. You want to go out of FANGs and into financials, industrials, and energy, all classic late cycle stocks that benefit from domestic economic growth as opposed to international growth. You want to go out of international companies into domestic ones. Bond yields will stay lower for longer as the 1% gets enriched further from this tax package. That means more money goes into capital preservation strategies in the bond market. Long-term investors will be punished at the expense of short-term ones through the loss of first in, first out accounting. Think of it as a backdoor capital gains tax for the small guy. Institutions are exempted. And you want to buy the highest taxed industries in the United States as we roll into a lower tax regime. Who is the highest tax industry in the US? The energy industry. That's oil and gas, telephone companies, industrials, utilities, consumer discretionary, consumer staples, financials, materials. And what is at the very bottom of the list? Who's paying the lowest tax rate in the United States? Technology. Yeah, you don't get any benefit from a tax cut in technology if you're not paying any taxes in the first place. Global economy, all signals are go. The Fed Beige Book says that all parts of the country are expanding modestly. There are severe shortages of technical workers. November Chicago PMI is up an incredibly hot 63.9. Q3 GDP revised up from 3 to 3.3%. Consumer confidence sees its biggest jump in a decade, from 126 to 130. Cyber Monday is now bigger than Black Friday, up 18% year on year, while visits to brick and mortar stores are down a recessionary 4%. 50% of all online sales now go through Amazon. Canada delivered a blockbuster November employment report of 79,000. It's all very market positive and severely limits the downside to any correction. Stocks are breaking out. Friday brought the most volatile day of 2017 as Washington rears its ugly head again. It is a preview of how 2018 will play out, which I believe will bring half the gains of 2017, but with twice the volatility. We bought into the dip on Friday, bought Bank of America as the seller's strike is still in force and remains so for the rest of 2017. Sector leadership rotates from FANGs to financials and industrials, and they will be the market leaders of 2018. This is not a one-day wonder. The bull market loses an important leg with share buybacks slowing to a 5-year low. That has been a major driver of share prices for the last 5 years. So my guess is that we get flatline sideways time corrections, brief spurts up, and then another time correction with no real serious pullbacks until next year. Volatility got a one-day visit to 1450 and then got crushed again. Synchronized global economic recovery, artificially low interest rates, and the prospect of a once-in-a-generation tax cut are a lot to sell against. This time it's different. Past market tops were defined by oil price spikes or interest rate spikes. This time, the sheer weight of asset prices may mark the end of the next recession, which is likely to start in 2020. That means stocks could rally for 19 more months. Dow 28,000, here we come. When the end comes, the downside will be more ferocious in the past, thanks to ETFs and new technology. And that is me at the USS Constitution, where the Marine Corps was founded, Semper Fi. My year-end target was 260. This was my January forecast. Everyone said I was crazy. There's no way the market would go up that much. But here we are at 260. We absolutely nailed it. And you can see the buy signals triggered by our algorithms. We bought in August. We bought again in September. Kind of rode the longs in October and bought the dip again in November. So the algorithm has really been earning its pay, and the results we're getting from subscribers have been absolutely fabulous. 10 reasons why there will be no 2018 crash. U.S. stocks are still one of the highest yielding asset classes in the world. Oil prices are still less than half of where they were 3 years ago and a third of where they were 5 years ago. Weak yen and euro are stimulating Japanese and European economies. While U.S. interest rates are rising, they're doing so at a snail's pace. Delayed U.S. interest rate hikes will keep the dollar cheaper for longer. Technology everywhere is hyper-accelerating, boosting profits. Stock buybacks and M&A are shrinking the supply of equities. Tax cuts will kick in eventually. Hurricanes created a big de facto infrastructure bill, and you can forget about any trade war with China. It ain't happening. Technology lives. The world's most profitable companies are huge beneficiaries of the corporate tax package. They will benefit the most from any cash repatriation plans. Apple alone will have $260 billion freed up to do what? Guess what? Buy back its own stock. Hyper-accelerating new technologies will mean that profits will keep growing at 20% a year, no matter who's in office. Tech makes a great hedge in case the domestic plays roll out slower than expected. Big institutions and hedge funds are loading up on every dip. Don't worry about any tech weakness you see right now. It always comes back. The only question is whether it is weeks or months. Here's the NASDAQ hitting a new high. Facebook, we got 2 buys in the last 18 months. One at the beginning of 2016. We got a double on, and another one at the beginning of 2017. That's been one of our most profitable trades. Apple, major buy here at the end of last year, right after the election. I believe it was December 1st. And again, we got a near double on that one also. Google, again, a major buy signal there with the rest of the fangs in 2016. And again, another double. If you get tired of getting doubles on stocks, then you don't need to listen anymore. Amazon, major buy in 2016. We doubled up again in 2017 because our algorithm told us to do so. And what did we get from that? A move to 1,200. Again, that's a triple from the 2016 low. European hedge equity, we follow. We haven't been trading much because there's so much going on in the U.S. We think this is in a long-term bull market also. And the same with Japan. Weakening yen is positive for the economy there. Expect this to continue. Tesla has been one of our most active traders for the last 10 years. We got in at the IPO at $16.50, rode all the way up to $390. You can see our 2 most recent buys, one at 140, another one at 180. And we took profits on everything at 394, and we never went back into it because of that double top right there on the charts. That means the free run is over, and it's now time for Tesla to prove itself by actually delivering 500,000 cars a year as promised. I happen to be one of Tesla's biggest customers. Bought 3 of them in the last 6 years. This is my most recent acquisition, the $149,000 fully tricked out with ludicrous mode Model X. Gets you from 0 to 60 in 2.9 seconds. warning, if you do go from 0 to 60 in 2.9 seconds, everybody else in the car will throw up. So we carry air sick bags in the little pockets behind the seats. You don't want to try this unless people are Marine combat pilots used to extreme aerobatics. This is my first Tesla. Best designed car in the world, doesn't hold up very well against a drunk driver on Christmas Eve who drove straight into my car. You can see in here the carbon fiber around the wheel wells. Here's the battery pack in the back. It's 1,100 pounds now. In 10 years, that'll be a 100-pound battery pack that gets you a total of 310 miles. Bonds, we're seeing a flight to safety. New tax bill promises to demolish the bond market, but it may take some time for it to roll over. Budget deficit is now climbing sharply from an Obama low of $450 billion to $700 billion, and it's now on its way to $1 trillion. Markets are now giving a 100% probability of a 25 basis point Fed rate cut on December 13th. That'll be the last big economic event of the year. Huge curve flattening is going on, 40 basis point spread between 10 and 30-year bonds. That is your early pre-recession warning, but it won't happen for 2 more years. Still looking for one more bond sell-off in 2017 to take yields to 2.5, and we are currently short the bond market through the TLT. $6 billion a month or $200 million a day in bond sales by the Fed is about to hit the bond market, and that is very negative for prices. And this picture shows what happens when you lose a bet as to who can ride a pogo stick at my age. Here's U.S. Treasury bonds. We've been very active traders in here, went short, caught a 20% move on the downside. We then went long at the end of 2016, rode it up all year long, and now we're playing again from the short side. It's like having a rich uncle that writes us a check every month. Here is the TBT, which is the inverse. This is the ETF that does better when interest rates are rising, and we've been very active in there. 2 major buy signals, 1 sell signal. Right now, we're currently long. Foreign currencies, we're seeing a dollar rebirth, prospect of huge deficits now driving the foreign exchange markets. Rising rates promises lower Japanese yen, euro, and Aussie. Huge Canadian November non-farm payroll report generated the equivalent of 743,000 jobs in just 1 month for Canada. That is an enormous number. Series of hot economic data points showing accelerating growth is underpinning the greenback. Political instability in Europe is still weighing on the euro. This means the new dollar bull market will have years to run. Oh, and by the way, the Bank of Japan says QE, quantitative easing, to continue indefinitely. Here's your UUP. You can see a major head and shoulders bottom there, looking for another leg up to start probably in 2018. Japanese yen, rally fails again. Look for new lows on this one. Euro, we are currently short the euro. We went short a couple of months ago, have been running it ever since, and that has been working very well. Energy, we have IPO fever. OPEC extended production curbs to the end of 2018, sending oil to a new high, and Russia is joining in on the curbs, who with Saudi Arabia will cut production by 1.8 million barrels a day. That is a huge win for Russia. Russia seems to be winning on every front right now, politically and economically, and whoever thought they'd be pals with OPEC. This is a green light to frackers in the U.S. to move full speed ahead, unleashing another new energy boom in the U.S. Synchronized economic recovery is pushing oil prices up with everything else. Fracking supply is on the rebound by the dips in energy stocks, and you might start with Exxon and Occidental Petroleum. Here's your oil breakout, and precious metals back in the spotlight. Gold is just holding on, trying to make a bottom, despite a huge risk-off bias in global markets. Get ready for a big jump in January when the seller's strike ends. Continued buying by the Russian central bank is putting upward pressure on gold. Hedge funds have started to dip their toes on the in the water. However, Bitcoin is definitely stealing away volatility from gold. Watch for gold to take off on any Bitcoin collapse. Buy gold and silver stocks on the next big dip, as still early days for the bull market. And that's me doing some early Christmas shopping in the gold market in Istanbul, Turkey. Did I mention I tend to get around a lot? Here's our recent buy and sell signals for gold. Again, we caught it in July. We took profits in the beginning of September when the big risk-on rally started, and we just went back in the beginning of November, looking to make a profit there also. Real estate is still bid. Home sellers are seeing the highest profits in a decade. Average residence is now 8 years, the longest in 20 years. 29% of all homes now sell for cash. That's up from 27% a year ago. Median home price is up 51% since 2009, and it's up 100% in the West Coast. Bond rally gives the refi boom another leg. S&P 500 Case-Shiller maintaining a strong 6.1%. Your home equity could become the best investment of the year again for the 5th year running. Home Depot has been one of our favorite plays here. Initiated a major buy thanks to our algorithm in August and has just run incredibly since then. Average home price index going to new highs. And U.S. home construction, another one of our big favorite sectors. That's the basket of home builders. Buy in 2016 and another buy at the end of 2016, which we have just run, and it's gone to new highs almost every day for the last 2 months. So what do we do about all this? Well, stocks, you want to buy them. Bonds, you want to sell them. Commodities, you want to buy those. Currencies, you want to sell them short. Precious metals, buy the dips. Real estate, buy, and then buy some more. Here's the long view of the markets. The 2000s and the 2010s were the hard decades for making money. The 2020s and the 2030s will be the easy ones as global demographic wave brings on a new golden age. And by the way, I just watched The Great Gatsby again on TV last night to be reminded of what a golden age looks like. Great parties, it seems. 85 million millennials will become big spenders over the next 15 years, while 80 million baby boomers, a drag on the economy, will fade from the scene. In the meantime, central banks will float our boats with QE until the demographic wave takes over. And that's me in Zermatt, Switzerland, watching climbers come down from the Matterhorn. I do tend to get around a lot. The last time we had a major demographic wave, the Dow average rose 20 times in 18 years. Are you ready for a replay? This is exactly what's going to happen. We probably will see a 20-fold return off of the 2009 bottom of 6,000. And where does that take you? It takes you to a Dow 120,000 by 2030. So all we're doing is just playing the same movie over and over again. There is no guesswork involved here. By the way, I traded that whole move from the very bottom in 82. I remember when Joe Granville put out a sell signal at the Dow of 600. He said it was going to go to 400, and it never looked back from there. If you want to make the best profits you can from these major trends, sit with me, John Thomas, the Mad Hedge Fund Trader, and my Global Trading Dispatch. Discover how you can tap into the top trade mentoring service in the industry, up 55.66% in impossible markets. Follow my research and market-beating trade alerts, and you will rake the profits in. Again, that's our one-year trailing 12-month performance, up 55.66% with no real drawdowns at all. Let a Marine combat pilot steer you to big profits, and no, that is not the plane I flew in Desert Storm. The one I flew had a few more engines and much bigger wings. Notice the design flaws. This is a 1932 de Havilland Tiger Moth, which I'm a part owner of. Gas tank is right over your head. Oh, and it has no brakes. You can only land it on a grass field and hope that the skid kicks in. We trade single stocks, options, and ETFs for global equities, bonds, foreign exchange, energy, commodities, precious metals, and real estate. This is a typical month for us. This was January this year. You can see we trade everything all the time, long and short. We have about a 90% success rate on our trade alerts. You can see here we made 16% on the S&P 500, 8% being short treasuries, 14% on the Russell 2000, and then made money on Amazon, Apple, lost money on Biogen, thanks to a certain presidential tweet. We do stop out of losers very quickly. It's easier to dig yourself out of a small hole than a big hole. But then we made all the money right back on a series of winning trades in Palo Alto Networks, the Japanese yen, US Treasuries, and the SPYs. This is how it works. I issued a major artificial intelligence report on November 2nd, recommending Nvidia when it was at $68.50. I sent out a trade alert by text and email, which gets to you in seconds from my desk. It says right here, buy Nvidia at $68.57 or best. It's an opening trade. For a $10,000 weighting, you need to buy 146 shares. What happened? Nvidia went through the roof, up 78.5% in 2 months. What do I do then? Sit on my laurels, sit around and watch TV? No. I sent out another trade alert saying, sell, take profits, sell Nvidia at 120 a share or best, closing trade. On your 146 shares, you made a profit of $7,508. We issue about 250 trade alerts like this a year. We've been in and out of Nvidia many times since then, riding it all the way up to the recent high of 215. With my Global Trading Dispatch, you get a daily research newsletter, instant trade alerts at market sweet spots, bi-weekly live global strategy webinars like this one, invitations to strategy luncheons around the world, unlimited access to our research database, and I'll even tell you the name of a great surfing camp in North Africa, which has a seniors division. By the way, it's a much harder than it looks. This is what I'm not going to charge you for this service. I'm not going to charge you $100,000 a year. That's what I charge my big hedge fund clients, and they're happy to pay because I make them millions. I'm not going to charge you $10,000. That's what I charge my concierge clients who get my personal cell phone number to act as an investment 911. And I'm not going to charge you $5,000. That's what I charge my advanced options trading clients. And I'm not even going to charge you $3,000. This is the cheapest price on my website. Today, I'm going to create a one-time only special deal just for you, guests of Cyber Trading University. Creating this product cost me millions of dollars. With the best customer service in the industry, running it costs me millions more. 3 months for just $497. Here's the offer you can't refuse. I know when it comes time to renew in a quarter, you'll happily pay the full $3,000 for a year. But you can only access this offer right now by clicking on the chat box on the right. There should be a link there to a dedicated sales page, which is only good for this offer. This is a limited time offer. We only take 25 new subscribers at a time. It's first come, first serve. I can't wait to make you a top drawer trader. Just click on the chat box on the right. Let me make the money for you to pay for your own subscription. You make the trades, discover how an experienced hedge fund manager finds and exploits the best sweet spots in any market. We told you which stocks to buy during the Trump melt-up. Who's going to tell you what to buy during the following meltdown? 3 months are just $497. Click on the chat box on the right. And let me go through a few testimonials here. Bill in Portland, Oregon, can we talk to you directly? Bill, absolutely. I spend part of every day calling readers and looking for ways to improve my service. You can email me anytime. We always answer same day. You also get a chat box on our bi-weekly webinars where you can ask questions like this, and you can get then a transcription of the questions and answers. Dan in Topeka, Kansas, what's the minimum amount of money I can start with? Dan, I'd say $10,000 to be safe, but I've seen people do it with as little as $500. We literally have students trading from their dorm room beds, paying their tuition. Another testimonial here. That's me at my Lake Tahoe office, where I work about 6 months a year. Jim in Dallas, Texas, are the trade alerts for stocks, ETFs, or options. Jim, all of the above. Every trade alert includes a range of possible securities, so readers can tailor it to their specific needs and risk profile. So if you can't do options, we give a stock alert, stock recommendations, an ETF recommendation, and so on. Joe in Detroit, Michigan is asking, I've never done this before. Can a beginner start with no prior experience? Absolutely, Joe. Bringing beginners into the market for the first time is one of the primary goals of this service. Here's me in New Zealand, and those are some real live black swans. I'm keeping my distance because they bite. Joel in New York City, how often is the newsletter sent out? Joel, every day the market is open. That's about 250 times a year. And Mary in Kansas City, Missouri, how many trade alerts do you send out? About 250 a year, depending on what the market is doing. Sometimes I'll send out nothing for 2 weeks, then you'll get 10 in one day. Sweet spots don't happen every day of the year. So here's the offer you can't refuse, 3 months for just $497. Just click on the chat box on the right. And Josh, are you with me? Or Eric, or anybody? Okay, well, I'll just assume the link is there. Click on the chat box on the right, and I'll go ahead and cover more questions. What is your best stock pick in the market today? Gary in Garden City, New York wants to know. I'm going with the financials, Gary, and in that batch, I'll take Goldman Sachs. Mergers and acquisitions are at all-time highs. Dodd-Frank is headed for the ash can of history, and interest rates are rising over the long term. These are all good things for banks. Goldman Sachs could double from here. We already have made a ton of money on this name. And we had a great entry point last week. You had to be pretty fast to get in there, and a lot of our people did. Here's another question from Robert in Seattle, Washington. You obviously have enough money. Why are you doing this? Well, that is a nice question, Robert. Teaching people how to make money and secure their financial future is the love of my life. When I was on Wall Street, I used to see so many people get ripped off by brokers, it made me sick. This is my chance to level the playing field for the regular guy. George in Austin, Texas, when does your letter come out every day? George, it'll be in your inbox well before the market opening every day. That way you have plenty of time to act on it and get your own orders in. Jim in Palo Alto, California, are you an algorithm? Gee, if I knew some great machine noises, I'd make it right now. All I can say is come to one of my lunches, pinch me if I bleed. You will know that I am not an algorithm, but you might also get a punch in the nose. So take your chances. Ivan in Portland, Maine, how would you describe your trading philosophy? Ivan, we use fundamentals for our long-term call and technicals for my short-term execution. It's what every long-term professional does. Okay. Do you, Roger in Richmond, Virginia, do you offer training with a subscription? We include more training you ever use in a lifetime with books and training courses. Every trade alert that goes out includes a link to a video with detailed instructions on how to execute it on your own training platform. So I'm going to leave the webinar open. Just click on the chat box on the right to see the link to our dedicated sales page. And this is John Thomas signing off for today. Good luck and good trading.